Hello everyone, welcome in the new session. Today we are going to discuss methods of calculating national income. We have three methods to calculate national income. First is value added method, second is the income method, and the third is the expenditure method. This is also called a value added approach, income approach, and expenditure approach. So let's first we start value added method, or it is also called a product method. Value added method is the method in which we measure the value added by each producing enterprise in the production process in domestic territory of a country during an accounting year. It means the value which is added by the each producing enter when we add these value by all producing enterprises is called a value added methods. In other words, value added is defined as the difference between the value of output and the purchase of raw material and the material used by the firm as in a raw form. So the difference between that is called a value added methods. So value of output we can calculate by sales plus change in stock, means sale during that particular years by the different firms, and plus change in stock. Change in stock we can calculate closing stock minus opening stock, the stock which is end in the last year and the remaining stock in this year. The difference is called a change in stock. If we will add sales plus change in stock, then we can calculate value of output. So if we will differentiate between value of output and the material which is used for production under the production process, the difference is called a added value added. So in this way, by the value added methods, we can calculate national income. We have different steps to calculate national income. The first step is to find out the national income is to calculate gross value added at a market price. So value of output minus intermediate consumption, the difference is called a gross value added at a market price. So gross value at market price we can calculate by difference between value of output and intermediate consumption. Now, how to calculate value of output? Sales plus change in stock. Sometimes the sale is given directly, sometimes directly sale is not given. In this way, sales to another firm, sales to household, sales to rest of the world, or export is given. So if directly sale is not given, then we will add all three. If directly sale is given, then there's no need to add all because it is already added in the sale, because that another specification is not given. Plus change in stock, closing stock minus opening stock. Closing stock, it means it is end of the year, and opening stock the first April or from the starting of the year. The difference is called a change in stock. If we add sales per change in stock, the total is called a value of output minus intermediate consumption. Intermediate consumption means the purchase of intermediate goods which is used in the production process. In the same way, like as a export, import is also given, but if directly purchase of intermediate goods is given, then we will not reduce the imports because it is already added in that. But if it is given in the another way, like purchase from another firm, purchase from household, and then import, then we will reduce import from the value of output. So if we will calculate difference between value of output and intermediate consumption in this way, the difference is the remaining is called a gross value at market price. The second step is to calculate net value added at market price. The difference between gross and depreciation is called a net. Depreciation or consumption of a fixed capital. It is the normal tear and wear of the assets. The difference of that is called a net value added at a market price. The third step is to calculate net value added at factor cost. Net value added factor cost is equal to the domestic income. So net value added market price minus net indirect tax. Net indirect tax is the difference of the indirect tax and subsidy. Then now the question arises the difference between market price and factor cost. Market price, the tax is added here, but in factor cost, tax is not there. So if we want to calculate factor cost from the market price, then we will reduce indirect tax and add subsidy, or directly net indirect tax is given, then directly reduce the net indirect tax. The next step is to calculate national income. NNP at FC is equal to the national income. It is also called a net value added at factor cost plus net factor income from abroad. If we will add net factor income from abroad in the net value added factor cost, the total is called a national income or net national product at a factor cost. So by these four steps we can calculate the national income. So we can see now, try to solve the numericals on the basis of those steps. So first, the data is given here. Sale is given 100, subsidy is given 2, consumption of fixed capital or depreciation is given 5, closing stock is 10, purchase of raw material is 50, opening stock is given 15, indirect tax is 10. Now, first we will calculate value of output. Value of output is equal to sales plus change in stock. Then we will reduce intermediate consumptions. Then the difference is called a gross value added at market price. The sale is given 100 plus change in stock. 10 is given closing stock. Closing stock minus opening stock. Opening stock is given 15. So 10 minus 15 is the minus 5. It means 100 plus minus 5 is the 95. Minus is the intermediate consumption. So minus 50. So 45 is a gross value added at a market price. Now we calculate gross value added at factor cost. The difference between market price and factor cost is only the net indirect tax. So gross value at market price is already we have calculated minus indirect tax plus subsidy. So 45 minus indirect tax is given 10 plus subsidy is given 2. So 45 minus 10 plus 2 is equal to 37 crore. So 37 is a gross value added at factor cost. Another example we can see how to calculate national income. Subsidy is given 40, sales is given 800, depreciation is given 30, export is given 100, closing stock is 20, opening stock 50, intermediate purchase is 500, and net factor income from abroad is 50. Here, one thing is clear that export is given, the directly sale is also given. So export we will not take here, only sales is given. Subsidy is given, but indirect tax is not given. So there is a no problem. Directly subsidy we will take. As per the given data, we will calculate national income. The first step is to calculate value of output. Value of output is sales plus change in stock. Sales is given 800. Change in stock is given 20 is closing stock minus opening stock. Then minus intermediate consumption is 500. The difference is 270. 800 plus minus 30 minus 500. So minus 530 is equal to 270. Now we calculate net value added market price. The difference between gross and net is the depreciation only. So gross value added market price minus depreciation. Depreciation is given 30. So 270 minus 30 is 240. So net value added market price is 240 crore. Now net value added factor cost. The difference between market price and factor cost is the indirect tax plus subsidy. So here indirect tax is not given, directly subsidy is given. So we will add subsidy 240 plus 40. Net value added factor cost is 280. And net value added factor cost is equal to the domestic income. Now we calculate national income. National income is related to the person, domestic income related to the place. So to calculate national income, we add net factor income from abroad. Maybe it is sometime given in a negative, sometime it is in a positive. But here we will add, if it is given negative, then automatic it will be minus. So 280 plus 50. 50 is given net factor income from abroad. So 330 is the national income. So in this way, we can calculate national income by the value added methods. Now some precautions when we calculate national income. The first precaution is value of sale and purchase of second-hand goods are not included in the estimation of national income. When any goods sale and purchase which is second-hand, because the value is already added in the national income, so second time the value is not included in the national income. The purchase of a sale and purchase of the second-hand goods. Value of intermediate goods, raw material are not included in estimation of national income, that already we can see there. The raw material is not included in the national income. We will reduce from the value of output. Value of production for self-consumption should be included in estimation of national income. The value of production for self-consumption, like for example, farmer keep their production for their home purpose, so that will be included, but it is the estimated value is included in the national income. In the same way, voluntary work done for community is not included in national estimation of national income. The work done for the charity without any transactions, that will be not included in the national income. Domestic services are not included in estimation of national income. This means the wife are doing a job, mother are doing a job at home, so that will not included. The domestic service are not included. Doctor working in home as a gardener, so that his service is not included in the national income. But their gardener are working as a gardener are working as a servant, as a providing service provided, so that services will be included. Imputed value of self-occupied house is included in national income. Imputed value, the assumed value of self-occupied house. We assume that if we will take house on rent and we will pay this, or if this house provide to for rent in any to an any other person, so that the rent we receive. So the imputed value of self-occupied house is included in the estimation of national income. So these are the some precautions which we keep in mind to calculate the national income. Thank you.